It wasn't a failure of industry. It wasn't a lack of innovation. It wasn't even a geopolitical defeat. It was the arithmetic of compound interest colliding with the limits of reality. The pattern is unmistakable. Civilizations rise on sound money. They extend on credit. They collapse on debasement. Current estimates place global debt at roughly $318 trillion, a number so large it ceases to be money. It becomes a political weapon and a mathematical impossibility. The arithmetic is merciless. When the debt burden exceeds the tax base, there are only two exits: default or devaluation. History shows that sovereigns always choose the latter. The incentive is survival. The mechanism is inflation. The result is a transfer of wealth from those who hold currency to those who hold real things. Silver is not just an industrial metal. It is monetary history waiting to reassert itself. To understand where we are going, we must look at where we have been. We will examine three specific case studies: the Roman Empire, the Spanish Empire, the Weimar Republic. In each case, the cycle is identical. Peak dominance leads to imperial overreach. Overreach leads to deficit spending. Deficits lead to currency dilution. Dilution leads to a flight into hard assets. Think about what that means. It means the price of silver is not a chart pattern. It is a barometer of trust in the state. Let's begin with the first clear example. Rome. 1st century AD. The silver denarius was the standard of the world. It was 98% pure silver. But the empire had costs, standing armies, public works. The dole. Emperor Nero faced a choice: raise taxes and risk rebellion, or cut corners. He chose the shortcut. He reduced the silver content of the denarius to roughly 93%. It seemed like free money, but the incentive structure had changed. Successive emperors followed suit. By the year 270 under Aurelian, the coin was barely 5% silver. It was a copper slug dipped in a silver wash. The consequences were devastating. Merchants demanded more coins. For the same wheat, soldiers demanded higher pay to buy the same equipment. The middle class was wiped out. A Roman centurion who saved for decades found his retirement fund worthless. The only wealth that survived was land, gold, and silver itself. Real silver, not the state's counterfeit. Just like Rome, the Spanish Empire fell into the same trap. 16th century Spain controlled the greatest resource boom in history. The discovery of the Americas brought a flood of silver and gold into the port of Seville. Yet, the Spanish crown managed to go bankrupt multiple times between 1557 and 1596. The costs of maintaining a global empire, fighting wars in the Netherlands, and suppressing the Reformation exceeded even the massive inflows of treasure. The crown borrowed against future silver shipments, effectively spending the money before it arrived. When the shipments were delayed or lost to storms, the system seized up. The influx of metal combined with reckless spending triggered the price revolution. Prices for basic goods across Europe rose by roughly 600% over a century and a half. The Castilian peasant, seeing silver everywhere, could strangely afford less and less. The sheer volume of currency could not compensate for the structural mismanagement of the state's finances. The lesson is clear. Even an abundance of money cannot solve a solvency crisis. When the state loses fiscal discipline, the currency loses its utility as a store of value. Just like the Spanish Empire, the Weimar Republic provides the most terrifying modern example of this dynamic. In 1914, Germany abandoned the gold standard to finance the First World War. The belief was that a quick victory would allow them to pay off the debt with the spoils of war. That victory never came. By 1919, the new republic was saddled with crushing war reparations denominated in gold marks which they did not have. The industrial heartland of the Ruhr was occupied. The tax base was shattered. Under these constraints, the rational move for the central bank was to print. They printed to pay workers. They printed to pay reparations. They printed to keep the lights on. In 1922, a silver 5-mark coin could buy a decent meal. By late 1923, the paper replacement for that coin couldn't buy a single crumb of bread. The paper mark evaporated, but the silver coin itself retained its purchasing power. The The piano teacher who had kept a jar of silver coins could survive. The neighbor who held paper bonds starved. The pattern repeats in 7 distinct stages. Stage 1 is sound money, where currency is backed by a tangible asset. Stage 2 is expansion, where the state begins to layer credit on top of real money to fund growth. Stage 3 is overextension, usually triggered by war or massive social programs, leading to persistent deficits. Stage 4 is the turning point, the debasement. This is where the state actively decouples the currency from its anchor to monetize debt. Stage 5 is consumer price inflation, which the state initially denies or blames on speculators. Stage 6 is the loss of faith, where the public realizes the currency is a melting ice cube and rushes to exchange it for anything durable. Stage 7 is the reset. The currency collapses or is redenominated and wealth is transferred to those holding hard assets, just like Weimar. The modern global economy is currently navigating the treacherous waters between Stage 5 and Stage 6. Current estimates suggest global debt has surged past $318 trillion. The ratio of debt to GDP in major economies rivals levels seen only during total war. The difference today is that the entire world is on a Fiat standard. There is no external anchor. Central banks have responded to every crisis since 2008 with liquidity injections. The balance sheets of the Federal Reserve, the ECB, and the Bank of Japan have expanded by trillions. The incentive is to keep interest rates lower than the rate of inflation to burn away the real value of the debt. This is financial repression. In this environment, silver occupies a unique position. It is historically undervalued relative to gold and equities. It is an industrial necessity for the green energy transition used in solar panels, and electronics. Physical shortages cannot be papered over forever. When industrial users cannot source metal for production, the paper price becomes irrelevant. The divergence between the spot price and the physical premium is the first crack in the dam. The risk is not that silver falls. The risk is that you cannot acquire it when the psychology of the market shifts. We are approaching one of 3 endgames. The first is controlled decline. This is the preferred path of central planners. They will attempt to hold interest rates below inflation for a decade, slowly eroding the purchasing power of cash and bonds while nominally honoring debts. In this scenario, silver appreciates steadily as a hedge against negative real rates. The second endgame is chaotic collapse. If inflation spirals out of control and the bond market revolts, the currency enters a doom loop. Confidence evaporates overnight. Capital controls are imposed. In this scenario, silver does not just rise, it skyrockets in purchasing power, becoming one of the few accepted mediums of exchange in a broken system. This mirrors the Weimar experience of 1923. The third endgame is a reset and restructure. This involves a formal devaluation of currency against gold and silver, or the introduction of a new monetary system, possibly a central bank digital currency backed by a basket of commodities to restore trust. In 1934, the US government revalued gold from $20.67 to $35. An overnight devaluation of the dollar of roughly 60%. Subscribe to the channel. Focus on education. Understand the difference between currency and money. Watch the debt to GDP ratios and the real interest rate data. Would you like me to highlight the key stages of monetary collapse, or extract the specific statistics mentioned in this text for a summary?